All right, so let's just jump right in. If you ever had that feeling, like you're just running on a treadmill in the markets, constantly busy, you're scalping, reacting to every single news headline, but at the end of the day, you're watching your capital just sort of erode, well, stop running. Today, we're going way past the basics, candlesticks and indicators. We're pulling back the curtain on the actual unseen hierarchy that really dictates who wins and who loses. We're launching into a deep dive on time, liquidity, and what the sources call the metagame of the markets.
And it's such a crucial topic because we're bypassing all that conventional wisdom that, frankly, traps a lot of new traders. Let's be really clear about this. The fundamental split in the market, it isn't about who has the better information or even who's smarter. It's based on one single thing: how different people define time. And this divergence is so huge, we call it the temporal canyon.
The temporal canyon. I like that. It immediately makes me think of two completely different worlds, operating under the same roof, that they just don't see each other.
They don't. It's almost like a conflict of physics, like you said. And our mission here for you, the listener, is to figure out where you sit in that canyon. Are you the fuel, the biomass that the system consumes, or are you the capital, the predator that feeds on that predictable biomass?
That choice, then, based on how you see time, it defines everything that follows. Your strategy, your profits, everything.
Everything.
Okay, so let's start at the bottom of the canyon. Let's talk about the liquidity class. The sources call them the younger trader, or as you said, the biomass.
Right. Their world is defined by this absolute rigidity. Their temporal paradigm is just ironclad. Now, for them is the closing bell.
So by 4 p.m. they have to be.
They have to be flat, no open positions. If they aren't, they feel this acute sense of exposure. And it's not just a personal choice.
It's institutional, right? Like prop firms, some funds.
Exactly. Their entire structure is built around avoiding that one specific thing.
Which the source material calls out as a deep-seated fear, the fear of the overnight gap. So what's the real cost of getting rid of that uncertainty?
The cost is your edge. You're sacrificing your edge for comfort. It's a huge mistake. They confuse eliminating uncertainty with acquiring profit.
And they're willing to pay for that comfort.
A huge premium. They miss massive opportunities, and they just systematically transfer their capital to the other side, all for the safety of being flat. They want microsecond control, but all they're really doing is making themselves completely, utterly predictable.
And that predictability, it shows up as what your sources call the illusion of action, all that scalping, the day trading. It looks like they're experts, but you call it a psychological tax. Break that down.
It's a tax because the activity is driven by a need to feel busy, to feel involved. I mean, think about it. If you're constantly jumping in and out, you're not just paying commissions and dealing with slippage.
You're burning yourself out.
You're burning cognitive energy. You're making emotional decisions. So you pay this tax just to feel like you're doing something. And all that churning, well, it's the perfect fuel.
So that collective fear-driven need to just liquidate everything at the end of the day.
Yeah.
That's their role. They are literally the fuel for the market engine.
Precisely. Their liquidations are so predictable, they create these exploitable price distortions. Think of it like a tide. The liquidity class creates this tide that, for a fact, is going to recede at 4 p.m. EST.
And when it recedes, it shows you where everything is on the ocean floor.
It reveals where the shells are, where the stops are clustered, where the unfilled orders are sitting. The big players aren't guessing about the tide. They're just waiting for it to pull back.
Which brings us to the other side of the canyon, the capital class, the ones waiting for that tide. Their relationship with time must be completely different.
Completely. Their clock is, for lack of a better word, geological. A day, even a week of price just bouncing around. It's noise. They ignore it.
So their now isn't the closing bell.
Their now is the completion of an entire market move. That could take days, weeks, sometimes months. They're thinking in trends, not in ticks.
But wait a second. If your time frame is that long, aren't you being inefficient? I mean, aren't you giving up all that short-term opportunity?
That's the key question, isn't it? But the capital class knows that maximizing your edge is way more important than maximizing your efficiency. They're not trying to scalp 20 different $1 moves.
They want the whole $20 move.
The whole thing. The one that results from the systematic exhaustion of the liquidity class. The time they wait is nothing compared to the size of the moves they capture.
So that overnight risk, the gap that paralyzes everyone else, for them it's just...
It's the cost of admission. It's a statistical variable they model and manage. The real genius of the capital class is in what they don't do. It's the power of inaction, strategic patience.
They're not reacting. They're anticipating the reactions of the reactor.
You got it. They position themselves at the river crossings and just wait for the herd. They get in when the liquidity class is panicking or liquidating or chasing some obvious breakout that's actually a trap.
There's a quote from the source material that really drives this home. It says, being flat every day is an advantage, all right, just not for the trader getting flat.
And that line is the whole thesis of this deep dive. I mean, so much of what we call conventional trading wisdom, the obsession with intraday risk, the need to always be clicking, it's just risk management theater. It's a show, a mechanism designed for the systematic transfer of capital from the predictable to the patient.
Okay, so we've established the two sides of the canyon. Now let's get into their internal operating system. The average trader is obsessed with the psychology, right? Mindset. But your sources lay out a totally different hierarchy, the alchemist's pyramid.
Right, the 8010541 breakdown. And it's an alchemical formula because it's about transforming perception into actual profit. It completely corrects this modern obsession with psychology.
Because psychology is the tiny little piece at the top.
It's a 1% capstone. It's not the foundation.
Yeah.
You need a rock-solid system underneath you before your mind even has a chance.
So the foundation, this massive 80% chunk, is all about the why, the structural imbalance.
Yeah.
And you say this is the hardest part.
It's the single most critical piece of the puzzle. The 80% is not news. It's not a head and shoulders pattern. It's the deep mechanics, the plumbing of the market. You have to be able to answer one question. Why should price have to move right now?
Can you give us a concrete example of that? What does that analysis look like?
Sure. It's about spotting liquidity voids, where big players couldn't get their orders filled. It's understanding that a huge cluster of options at a certain strike price is acting like a magnet on price. Or, and this is the most common one, it's about seeing a giant pool of retail stop losses just sitting below a key low. That level is no longer support. It just became a target, an irresistible target for a liquidity grab.
So you're calculating the market's vulnerability.
That's the perfect way to put it.
And once you have that 80% why, the other pieces sort of fall into place. Next is the 10%, the direction.
That's right. If your structural analysis shows you that patient capital is quietly buying while retail is trapped short, well, the only logical direction, the vector, is up. After they grab that liquidity, of course.
It's a conclusion, not a guess.
And an unavoidable conclusion based on the structural evidence.
And then we get even more precise, the 5%, the when, the trigger.
This is the convergence point. This is the exact moment the structural why meets a technical signal. It could be the instant price sweeps those stops, reverses hard, and reclaims a key level. And this is so important. Being generally right is worthless in trading.
You have to be right at the right time.
At the perfect moment of maximum structural advantage, that's the 5%.
And the 4% is risk management. I love how the source calls it the pact with reality.
Because that's what it is. It's your pre-negotiated surrender. You decide before you're in the trade what price action completely invalidates your entire thesis. It has to be a hard line in the sand.
This is what keeps you in the game.
This is what lets you be wrong half the time and still be profitable. It protects you from the market, sure, but really it protects you from yourself.
Which finally leaves that tiny 1% at the top of the pyramid. Psychology, the capstone. Why so small?
Because if you've done the 99% of work below it,
Yeah.
if you know your why, your direction, your when, and your risk, psychology isn't a battle anymore. It's just calm, robotic execution.
It's just following the plan.
Exactly. The source has this great analogy. Relying only on psychology is like being a captain trying to steer a ship with no hull, no sails, and no destination. Your willpower is useless if there's no structure underneath you.
So the pyramid gives us the structure. How do we actually go out and find that 80% why? The sources suggest a method for this, right? Viewing the chart as a schizophrenic chart.
Yes, it's a kind of meta-technical analysis. It requires you to hold two opposing views at once. You have to stop looking at the chart for your own signals and start seeing it as a map of other people's intentions.
And you start with the retail lens.
Always. You have to put on their glasses first. Ask yourself, what is screamingly obvious on this chart? Where is the comfort? Where is the confirmation?
Okay, so they're looking for clear support that's held a few times, or an RSI that's obviously overbought.
Yes. They want clarity. They want the comfort of the crowd. So they buy the obvious breakout. They sell the obvious breakdown. They move in a herd because it feels safe.
So let's take an example, a double bottom. Price hits a level twice and bounces. The retail lens sees that as guaranteed support.
Guaranteed. So they buy the bounce, and then they put all their stop losses right below that second bottom, feeling totally safe. And that predictability, That's the target.
Because then you immediately switch to the professional lens.
You overlay it, and the professional looks at that same double bottom and asks a totally different question. Not where will it bounce, but
How much money is sitting in stops just below that level?
exactly. The professional is looking for ambiguity, for misdirection. They need to know where to push price to collect that pool of liquidity
Yeah.
before they take the market in the real direction.
So the move that breaks the double bottom isn't a failed pattern.
It's a structural necessity. It's a liquidity grab. It's
Right.
the fuel for the real move up that comes right after.
The retail trader wants certainty. The professional wants to exploit a moment of calculated betrayal.
That is the perfect summary. You're calculating the difference between the possible and the probable. The market could possibly go anywhere. But based on the structural imbalances, the stops, the options, the unfilled orders, there's a very narrow path it is probable to take. The professional's entire job is to calculate that probable path.
Which often means tricking the liquidity class first.
It almost always does.
Okay, so as we wrap this up, it all has to come back to what the sources call the zero-sum reality.
It has to. We have to remember the market is zero-sum in terms of capital. For every winner, there's a loser. But when you factor in commissions, fees, slippage, it's actually a negative-sum game for everyone playing.
So to win, you can't afford to be part of that predictable flow. You have to make a choice. Are you going to be the liquidity, driven by fear, short time frames, constantly paying that tax?
Or are you going to expand your time frame? Are you going to become the liquidity taker? Hunt for that structural Y, that 80%, and learn to use patience as your primary weapon. The market rewards those who wait.
Not those who rush. It's that structural thinking, that mastery of time that makes all the difference. And so we'll leave you with a final thought to chew on this week, and it comes directly from the source material. The predator who can wait the longest often eats the best, say. So ask yourself, what massive opportunity are you paying a premium to avoid, just for the feeling of safety? By, for instance, religiously getting flat every single day, that premium you pay, that's the silent cost of fear. And it is the reliable, predictable fuel for the capital class. We'll see you next time.